Well, hey everybody, welcome to Steve Cooper's podcast for aspiring real estate investors. I'm ever so pleased because today my guest is the amazing Darren Mitchell from Control and Compound. You may or may not have read the book Be the Bank. Well, I tell you what, if you haven't, you should. There is so much to learn about this. I can't wait to get into it. Let's go, Darren. Tell me a bit about yourself and how you got into this amazing field.
Well, like a lot of Canadians, when I was 5 years old, my plan was to play in the NHL. Quickly, by about five and a half, I realized beer league hockey was more my future than the NHL. So at that point, I switched to insurance as the dream. Like a lot of people in this industry, I kind of fell into it. I graduated. I did an economics degree and an MBA in finance, and it was the 90s, and there weren't a lot of jobs out there. So there was a job opening with an insurance company, and I said, well, I'd never want to work in insurance, but I should go for the interview just for practice. It'll be good practice. Anyway, went for the interview, and sure enough, I ended up in the insurance business right out of university. I spent about 12 or 13 years on the corporate side. My last role was director of sales for a major insurance company. And then it'll be 20 years in February. I started my own practice that has evolved into Control and Compound. So 20 years as an entrepreneur now, and our sole focus is cash value life insurance, the infinite banking concept, and we help clients from coast to coast and all the provinces and territories, and we just love what we do.
I can only imagine. I'm discovering rather late in the game the differences between term life insurance and cash value life insurance policies or whole life. I can't tell you how sad I am to realize the mistake I made at an early age. Speaking for myself, I understand that I didn't put enough focus and research into it, but do you find that a lot of people are in the same boat? Like they're saying, "Oh, what am I missing here?" Because you know, as you reach certain plateaus in age, the insurance companies all of a sudden want to bump your premiums, double them almost. You don't have any residual left there if you've got a typical term insurance, and yet that is the product that's being pushed to most Canadians as we start out and say, "Oh, I need insurance." You don't know one from the other. Tell me about how did the industry ever find itself with a product like a term insurance policy that doesn't really support you as you get to a point where you need to lean on it, um, where the whole life insurance policy is such a logical choice. I'm finding at this age. I mean, I don't know.
Yeah.
Maybe I'm stupid here.
Oh, no, no,
Help
no, you're
educate me.
you're bang on. And in fact, when you say you learned about this late, one of the most common things we hear when we meet with new people is, why haven't I heard about this before, and why isn't everybody do it?
Hmm.
We always say people are kind of suspect of the concept, but once they learn about it and once they're educated on it, because it really does take education, and that's why I wrote the book, Education to Learn About This. You're not going to learn about it in 20 minutes, but we say once they catch it, they can't uncatch it, and they realize the importance of that. Now, on the term insurance, I think term insurance is a great vehicle for certain people in certain circumstances, but it is oversold, and you're right. People should be looking more at a whole life insurance when they start, making a little money. But one of the interesting things about the way we design the policy. So there's two components, a cash value and a death benefit, and we're able to drive down the death benefit. Our goal is to drive down the death benefit as low as possible starting out. It'll grow well, it'll go great long term. But when we drive that down, that allows us to drive the cash value up. So if we actually, people think they're too late to this, but if I showed you an illustration for a 30-year-old, a 40-year-old, or a 50-year-old, and we just compared cash values on a whole life, the cash values on those three ages would be virtually the same after 15 or 20 years. Now, the 30-year-old would have more death benefit than the 50-year-old, but people think they're too late to the game for this concept. And yeah, you might be too late to the game to get cheap term insurance, but you're not too late to the game to grow cash value. And that's what most of our clients are interested in, the cash value. And then the death benefit, when they get older, all of a sudden they realize how important that is and how valuable it is. But starting out, it's mostly the cash value people are interested in.
As they should be. I mean, it's really amazing. So speaking of books, let's see if I can get it in focus here. Be the Bank. What a great title. I love this book. I
Thank
love
you.
this book. You talk about the WIM account in here. Is it wealth and income maximization accounts? Great term. So tell me about that. What is a WIM account?
Yeah. So, well, I'll even back up a little bit. So when I started really digging into this concept, I literally spent 2 years pursuing my own education. All my education came from the insurance companies, the banks, the mutual fund companies. So when 2008 happened and I saw all these people lose control of their money and just devastating things, I started studying the wealthy, and I spent 2 years traveling around North America studying what the wealthy do. And the wealthy people really, they invest in three things and three things only. So, the big takeaway is if you want to be wealthy, do what the wealthy do. And the wealthy invest in three things. They invest in themselves, they invest in businesses, and they invest in real estate or any or other hard assets. And that's really it. So where the cash value life insurance or the WIM account comes in is the investing is really step two. Step number one is, where do you save or store your wealth? And what I learned from studying the wealthy is the number one factor they're looking at is they want to be in control of their money. And cash value life insurance puts you in control of your money. It goes in, your cash value grows guaranteed every year. It's going to grow roughly 5 or 6%, but it's guaranteed not to go down. Market crashes 40%. It goes up every single day. People were calling me during COVID going, "What's going on with my policy?" And I'm like, it's going up every single day like it has for 150 years. And they're like, "Okay, I'll go back to washing the vegetables and worry about something else." When we get into really how it fits into a plan, I look at the three most important words in the English language for me: control and compound. Name my company after that. But control is step one. So I promise every listener there's going to be opportunities come your way, and there's going to be financial emergencies come your way. And how you're prepared to deal with those will fundamentally change your life and your family's life.
Yeah.
So the control part is the base of your financial plan. You've got to have some money that's in control. RRSPs, you're not in control of that. If a great opportunity comes along and the market crashes 40% and your RSPs are down, you're not in control of that money. So the cash value life insurance, you're in control of that money. You can access a loan and take advantage of an opportunity or deal with emergency. So the control's big. And then the and word is, every asset you own is an or asset. Do I put money into real estate, or my RSP, or my TFSA, or into my house, or into my business? This is really an and asset. So when we put money in the cash value life insurance, it's going to grow completely tax-free. And then when we see an opportunity, we can say, like, I bought a fourplex a couple of years ago in Ontario. I literally went to the insurance company and said, I would like an $80,000 loan. And they said, yes. They didn't ask me what it was for, when I was paying it back, how I was paying it back, financials. I took that, and then I went and got the mortgage for the other 80%. When I did that, my cash value continued to grow. So it was in the policy growing exactly the same whether I'd taken the loan or not. And it was also in the real estate opportunity. And it was providing a death benefit. So I've multiplied money kind of like a bank. And then we can get into the compound, who's the third word, a little later, but I'll pause there to see if there's any questions.
I think that's a beautiful approach where you're managing to keep something growing, even though you're taking a portion of it away. And that approach, I think, is rather unique. But that was the hook landed in me when I heard that, and I was like, okay, I got to learn more about this. I've been studying it and trying to understand how it's going to best suit my needs. And when I've got a young son, he's 16 years old, I'm thinking to myself, okay, well, here's the perfect opportunity. At the very least get him a policy. But the ability for this to actually continue growing, you're saying there's a guarantee for, it's not going to go down. It's going to keep increasing 5 or 6%. How do they manage to do that?
Yeah, there's about 10,000 different insurance products in the country, and there's only four specific products that we can use for this concept. So there's four different insurance companies, and each of them have one product we can use. So it's a specially designed product where the policyholders actually own the fund, and it's invested in pretty conservative stuff, but it's got a track record of 150 years. The newest one we use has a 100-year track record, And every one of these four companies have never, ever, ever missed paying a dividend. Now, so I say the guarantee only kicks in if they don't pay a dividend, but they've paid a dividend each and every year. World War I, World War II, the dot-com bubble, you name it, they invest conservatively. They got a reserve fund in the bad years they can dip into. But what I love about the compounding is if you want to be like the wealthy, they get on this exponential growth curve, the compound curve. And the magic is don't get off it. Never get off the compound interest curve. So what knocks you off the compound interest curve? And I have a chapter in my book about this. It's the four wealth destroyers. So if you want to tackle the four wealth destroyers, it's the only way to true wealth, and that's what the wealthy do. So when you're inside this policy, it grows tax-free. Your loans are tax-free, and your death benefit is tax-free. So that's the number one wealth destroyer, tax. Second thing it does is the fees on this product. The average mutual fund is still over 2% fee. The fee on this is about 0.13% is the average. So incredibly low fees. So we're fighting the fees. Volatility, we talked about. There's going to be no up and down like the stock market. Regardless of what's going on, you're going to have access to that money because it's guaranteed to go up, and it has a 150-year track record of paying a dividend. And then the spending is the last one we kind of touched on earlier. What most people do is they save money, start compounding on that compound growth curve, and then they go pay cash for something and they go right back to zero. And they restart the compounding. Or they compound until maybe age 55, 60, 65, and then they start spending the principal. You could be 55 years old, do a cash value life insurance policy, and get another 30 or 40 years of compounding because you're never going to stop the compounding until the day you die. Yeah. Because the magic at the end is, well, now I can access in retirement tax-free loans that I never pay back, and you die with an outstanding loan, the death benefit comes in. So let's say you spend $100,000 a year for 10 years before you die. You owe $1 million. Well, if your death benefit's $2.5 million, the insurance company comes in, says, great, we're going to take $1 million to pay off the loan, and we're going to give you $1.5 million to the family to keep the properties in the family, keep the business, legacy, whatever it is. So it really allows you to compound forever, allows you to access that money. And I used to think the compounding was the most exciting part, but after doing this for 20 years now, I think the control is actually even more important, because you'd be amazed at people that, an amazing real estate deal comes along and they need money quickly without all the financials, or the banks are giving them a hard time. The ability to literally look in the mirror, and if the person in the mirror says, yeah, you can get a loan, that's the only requirement you have for a loan. So these loans are guaranteed. You can pay them back however you want. So when, how, and if you want. So if you want to make no payments for 2 years, no problem. You want to pay it off in 6 months. You want to pay a little bit every month, and then in six months, pay the rest off. So that flexibility, and that's why we've kind of pivoted into helping so many real estate investors, business owners, and wealthier Canadians that really want that control for opportunities. So it's been a pretty fun ride.
It sounds amazing. It really does. It's almost too good to be true, I got to tell you.
Yeah.
Now, you mentioned the cash value portion of the life insurance policies. If I understand correctly, say you had $1 million, the cash value component of that $1 million policy is going to be somewhere in the 95% range, right? Is that correct?
Yeah, no. So there's going to be two different columns sort of in your policy. We're going to have a cash amount or cash value, and that's the amount that you can access. 90% of that tax-free is via a loan, and that doesn't affect the compounding. And then we have a death benefit. The cash value is always going to be less than the death benefit. And then the loan will always be less than the cash value because 90% is the maximum loan. So that's why there's always a spread when you die versus what you have outstanding, because the cash value is higher and the death benefit's even higher. So the typical policy, I kind of equate it to buying a property and doing a reno. You're underwater year one when you do a reno. You're going to be rich long-term, but you're underwater year one. So a typical policy when you start, let's say it's $25,000 a year deposit. And I hate the word premium because premium to me is like a car insurance premium. It's an expense. You pay it, it's gone. This is just, I'm saving in a different spot. instead of saving in a bank or saving in wherever, I'm saving inside this policy. So it's just a redistribution of where you're saving your money. So typically year one, your cash value is going to be maybe 70% of your deposit. So you're underwater, and the insurance company has fees and setup, and they got to put a reserve for the death benefit. But then typically by year three, you're growing by at least what you're putting in. And then by year four, now you're on that 5 or 6% long-term growth. So your cash value starts a little slower. So, when people say, who is this not for? And if you need every single nickel you have, if you've got 50 grand in the bank and you need every single nickel of that 50 grand in the next 12 months, probably not a good strategy for you at this time. But if there's some portion of your money that you're willing to have slightly less access in the first couple years in order to be incredibly wealthier long term, then it's a great concept.
Sounds like a great fund. I want to start diving into understanding how this can benefit businesses. That's the gray area for me, because I see I understand that businesses are able to take advantage of this policy or this approach as well. With all of the businesses that you're running, you're carrying a reserve. It's typically earning nothing, and yet you're keeping it like your own insurance policy for the what ifs. Can you use an infinite banking approach as a business? How? And tell me more about that. So open the door for me.
Yeah. But most of our larger policies are business owner clients. We have a lot of business owners. I'll tell you a quick story. I met with the head tax strategy guy for Deloitte after the last budget. And I go in the boardroom and he looks at me and he's got a little scowl on his face and he goes, well, you must be happy. And I go, what did I do? He goes, you're all we have left. Every tax advantage the business owner community has had over the last 9 years has been evaporated. And the last one of the last budget, they get rid of this surplus sweep thing that we could do to switch profits to capital gains and get them out a little less tax. He goes, you're all we got left. So when I started in this business, a lot of the big accounting firms weren't pro insurance, and now it's just the opposite because they see the benefits of it. To walk you through a business owner situation. So a typical small business on the first 500,000 of profit, you're going to pay about 12% tax, depending on what province you're in, anywhere from 10 to 12. So that's great. If you want to take $1 in your company and pay it out to yourself personally, most business owners are getting about 50 cents. And they can take that one of two ways. They can take a salary and they're going to pay roughly 50 cents. So then they have 50 cents to invest. Or they pay that 12% tax and then they give themselves a dividend, and they probably still have about 50 cents personally. So business owners in Canada go, well, I like 88 cents and better than 50. So why don't I leave that money in my corporation? Which again, great strategy. I do it myself. The challenge for business owners is once you have that money inside your business or retained earnings, then what do you do with it? And as you said, most people put it in something pretty stable, secure, short-term, low interest rate or no interest rate, because they may need that money. They may need access to it for payroll. The second challenge is you think there's a lot of tax personally. Well, now corporately, if I invest those 88-cent dollars, so let's say I made 100 grand extra in my corp this year that I didn't need, and I have $88,000 left over after the tax bill. That $88,000, let's say I put it into something like a bond or something short-term. I'm going to pay tax on the growth, upwards of 50%. I'm going to pay tax when I go to spend it because I got a dividend in to get it out of my corporation. And I'm going to pay a boatload of tax when I die. And then if you make more than $50,000 of passive income, they're going to hammer you on your small business tax deduction. So there's potentially four levels of taxation on that dollar. So it sounds great, those 88-cent dollars, but now you've attracted 3 or 4 more levels of taxation. So the wonderful advantages of the Tax Act in Canada is corporate-owned insurance policies are treated like personal policies where they're completely tax-free. So now we have that business owner to say, I'm going to take that $88,000, fire it inside a cash value life insurance policy. The growth is going to be completely tax-free. When I need access to a loan or spend it, it's going to be completely tax-free. When I die, not only is the cash value, but the death benefit going to pay to my corporation tax-free, flow to my corporation tax-free to my to my family or surviving beneficiaries. So typically what I do in a corporate policy, for instance, that fourplex I told you I bought, that was inside my holding company. So I had retained earnings in my operating company, rolled them into my holding company, purchased a lot of insurance policies. I have 9 of these now with multiple 6 figures going in. And I use that as an opportunity fund to say, anytime there's an opportunity, I'm like, great, let's buy that fourplex. I bought the fourplex. It was good timing 4 or 5 years ago, skyrocketed in price. It's cash flowing, pay off that loan, rinse and repeat. It didn't affect my growth whatsoever. So you can use it corporately in the early years. But then the magic for the business owners is my goal is to be in a 0% tax bracket in retirement. And the way you can do the magic you can do with a corporate policy. And now you got to be dealing with a firm that kind of specializes in this, because a lot of people can screw it up if it's not set up correctly. But let's say I start a policy and I'm putting a bunch of money in every year, saving for it. I'm a business owner and I need to make payroll next quarter. No problem. I'll get a loan to do that. I want to buy the building next to me. Great. I do that. You take advantage of 10 opportunities along the way. Your cash value continue to grow, and you hit retirement and you go, all right, Darren, I got this big old cash value amount now in my company. I don't want to do any more deals and access loans. What do I do now? Well, now think of that. You've only ever paid that 12% tax. You've grown it to a massive amount. You can actually get personal loans on a corporate owned policy. So in that scenario, let's say you grew it to $2 million as a business owner, you could go into retirement and saying, why don't I take a $200,000 personal loan? Loans are tax-free. I'll let the interest capitalize. I'm not going to pay the interest. And I'll just, whatever your other retirement income is, I'll have 200 grand additional on top of that to spend personally tax-free. And then when I die, now the death benefit is $3 or $4 and $5 million, whatever it grew to. That goes to the corporation tax-free, flows out to the family, the loan gets paid off, and the family gets millions of dollars. So we're not kicking the tax can down the road like an RSP where there's going to be a day of reckoning. We're actually just paying that 12% tax and then eliminating 3 or 4 levels of taxation for the next 20, 30, 40, 50 years.
It's magic.
Well, it is funny when we show people the corporate stuff, we go, okay, we're going to show you the next slide. And we're going to compare it to a traditional investment, to the insurance and how much you can spend in retirement and how much money you have. And we go, we just want to warn you up front. It's going to look really, really good. And it's not because we're getting some magical 38% return and putting you in all this extra risk. We're actually reducing your risk, putting you in the most conservative thing. But if we can eliminate 3 levels of taxation, that's where the magic is, because tax is your number 1 wealth destroyer.
It sure is. It sure is. So the whole principle is based on the Rockefeller family, right?
Yeah. So we've got a new book we launched. What would the Rockefellers do? Garrett Gunderson, the author. I was actually fortunate enough to write the foreword for the new version of the book for Garrett. So we have a whole Rockefeller thing, and the Rockefellers and the Vanderbilts were the 2 richest families back in the day. And within 2 generations or 3 generations, the Vanderbilts had nothing, and the Rockefellers are still incredibly wealthy. 200 people living off the trust. They donate $50 million a year to charity. They're incredibly successful because they did what a lot of wealthy families do. And if you went through all the wealthy families in Canada, I can promise you they're all following this cash value life insurance strategy, where they literally put policies on every single family member, grow the cash value tax-free, and they're using trusts. That's like, with significant wealth, they're getting into trusts. And then great, kids goes to university, wants to start a business, wants to buy real estate. They're accessing loans, they're paying the loans back. And then if they don't pay the loans back, it's a self-fulfilling like waterfall method, because there's going to be a death benefit every time the family member dies. So the death benefit goes back into the trust tax-free and continues to grow. I'm not sure when this comes out, but we actually are having a Rockefeller masterclass on, I think, November 25th, where we have one of the top accountants in Canada talking about the trust. We've got Garrett Gunderson and my partner, Christina Wyatt, myself, talking about this. But on our website, we've got a whole Rockefeller video series, our podcast. I think we've done 8 podcasts on the Rockefeller. The Rockefeller is basically more the wealthier people are looking at the Rockefeller. It's the same concept as infinite banking. It's just when you get to a certain level of wealth, incorporating those trusts. And we were fortunate to work with some great legal and tax minds where we were able to actually create a Canadian Rockefeller trust that had never been done before. In the States, they have this thing called Dynasty Trust that goes on forever and ever. In Canada, we got this 21-year rule on our trusts. But we've been able to do something creative and get a Rockefeller trust where the 21-year rule doesn't apply. It's a pretty cool concept.
It sounds amazing. I can't wait to hear that and see what comes up. I'm going to get the book as soon as it hits the shelves for sure. Darren, I've got 1,000 questions I haven't asked, but I don't have enough time to get through them all. But if you were to help me out here, what's the one thing that we should have talked about and didn't hear? And what do you got left for me?
Yeah, I think I want to go back and reemphasize that control, because I've seen so many people through the years not be able to take advantage of opportunities because, well, let me back up. So I always say 90% of the wealth is tied up in the hands of 10% of Canadians.
Mhm.
But what strategies do we follow? We follow the strategies of the 90% that have 10% of the wealth. So the traditional RSP, save every month, get ahead. And if you want to be wealthy, I truly believe step one is taking control of your money, and then invest, and then leveraging that money to invest in you, a business, or real estate. So if the listeners took away one thing, number one, you've got to look at all your assets you have now. We have clients do this sometimes. And we do little wealth boxes. You get your RSPs, you get your real estate, you get your house, you get your TFSAs. Okay, which one of these are you in total control of? So if the real estate market and stock market crashed, could you take advantage of an opportunity? Which one of these are tax-free? Which one of these grows tax-free? And which one of these will allow you to retire tax-free? And which one of these are going to leave a massive death benefit? So there's a legacy and or business continuation, or real estate stays in the family. And people kind of realize, wow, I'm not in control of my money. So I don't think this is for all your money, but certainly for a portion of your money. People say, well, how much do I have to put in? And I'm like, you don't have to put in anything. How big of an opportunity do you want to take advantage of? And for me, I want to take advantage of big opportunities. So I put significant amounts into this each year, because you have to save somewhere. You might as well save in the most tax efficient place that is literally your own bank.
I love it. I absolutely love it. So there you go, folks. If you want to follow the clues that the rich people have left behind, then you need to be reading the book. Reading the book. Be the bank. You need to listen to what Darren's got to say. Darren's got a podcast that's always in my inbox. I'm always seeing something new come up. I can't wait to see this next Rockefeller method, and I appreciate you coming on the show. Thank you ever so much, Darren. I appreciate you, and thanks for joining us and sharing your insights with my audience. Appreciate it.
Thanks so much. Anytime.